Hey guys, it's Downtown Josh Brown. We're here for another round of What Are Your Thoughts? I'm here with Michael Batnick as always. And we have a new way that we want to talk about doing the show, which I'll get to at the end. But for now, big topics on the street this week, lots happening. Let's get into the music and then we'll go right in. All right, so Michael, Barry, my partner, your partner, Barry Ritholtz, interviewed Dave Portnoy last week. And at first I was a little bit nervous because I was like, what the hell are they going to get into? And can Barry back himself out of something that he's not really supposed to be talking about? But it didn't go that way at all. I thought it was a really interesting conversation on entrepreneurship more than anything else. Did you prep him for that?
Yes.
What did you do to prep him to interview Portnoy? Because I don't think Barry's a stoolie. I don't think Barry's a big Barstool guy.
So he was nervous that it was just going to be like bullshit stock picking and stuff like that. I was like, you don't understand. He can be a serious person. He's playing a character sort of like Andrew Dice Clay, but he has the ability to talk seriously. And so that's what it was. I thought it was a very meaty conversation. It was great.
I mean, the guy sold Barstool twice. He sold like a controlling interest to the Chernin Group, which is a serious media operation, and then sold the rest of it to a public company. So he's not just walking around with a green hammer, to ring the opening bell of day trading. Like he clearly knows what he's doing. I was very struck by, and I didn't really understand this, the fact that he basically was toiling in obscurity for a decade. He was like writing all the articles in this handout newspaper. Then he was editing himself. Then he was printing it, and then he was delivering it. He was selling all the ads, and he did that for a long time before anyone ever heard of him. Really, like before there was Twitter, or any way for him to go broader. And I thought that was like I respect that so much. Did you know the whole story going in?
Yeah, I've heard that stuff before. I loved what he said about. I did love his stuff about stocks. That he's like, they're laughing at me on CNBC, but I don't really care. He knows exactly what he's doing. He said it's a slow motion train wreck that you can't look away from.
One of the things that I like about what he's done is that he doesn't take himself seriously as a trader. And I think the reason that pisses off so many professional traders who like live and die by their reputation on social media is how little he cares about what anyone thinks and how little he's trying to pretend that he knows what he's doing. He's just like, I don't know. Let's trade this. Let's trade that. It's refreshing.
Yeah, he said he saw a deer outside his house, so he bought John Deere.
I saw him pick a ticker symbol out of a Scrabble bag and then trade it. So he picked the tiles.
The thing that triggers people, the thing that you see the people that have been bearish for 5 years quote tweeting is Portnoy saying stocks only go up. And obviously that can be a dangerous mentality. But the irony is, don't you think that you're way more likely to make money if that's your mentality versus stocks are always about to crash? Which is what his detractors say.
So I don't even think the direction, maybe you probably know better than me. I don't really think the directional thing is what triggers people. I think it's the fact that he's having fun and not taking himself seriously. And he actually has some trades that work out. I mean, I'm sure they don't all, but I think there are people that take their research and their trading so seriously, as they should if they're really professional traders, and he just shows up and totally makes a mockery of the whole thing. And these guys are like, no, wait, subscribe to my bullshit. Look how great I am. And he's like, I suck. Follow me anyway. I don't know. I think it's cool.
That's become his thing. Stocks only go up is like his tagline.
Right. All right.
So that pisses people off because it sounds so ignorant, and it is, and it's dangerous. But the irony is that the people that are like getting triggered by him are the people that are always afraid that stocks are about to crash. So it's a perfect storm of butting heads.
Imagine you're like one of these like macro fake hedge fund guys on Twitter, and you like spend 16 hours a day on your research and tweeting stuff out and all this shit, and like you put out something and like 5 people like your tweet, and then he comes along and he's wearing like a Superman costume, and 300,000 people see his tweet. Like how emasculating is that?
Yeah, that's tough. I certainly get the frustration.
Right.
I wanted to talk to you about solar stocks. Were you aware of what's going on in this space?
You know what? I should have been. I was a little bit aware of the fact that they kind of took off with Tesla this year, but I didn't realize the extent of it until I looked at some of the charts. And holy cow!
Yeah, so I was digging like what's going on. So solar accounts for just 2% of total electricity generated in the United States. And when was First Solar and SunPower and Solar City? When were these the hot stocks? Like 2013? It's been a long time.
So, yeah, I was probably 13, I think.
It's been a long time since they've been in the news. But there's this one stock, Enphase. It's up almost 250% year to date. So I'm looking like what's going on, and like it's these are no longer just ideas. The revenue growth is pretty tremendous. There was an article in Barron's recently talking about what's going on in China. I think it's like 8% of their electricity, something like that.
Yeah.
The scope of Xi's ambition in a country that still gets 2/3 of its power from coal is breathtaking. There's an estimate that China will have to spend $15 trillion on green transformation, increasing solar power 6 times and wind more than 3 times. So you contrast what's going on in the clean energy space. There's also a ticker from iShares, ICLN, iClean, which is pretty similar to the solar ETF, TAN.
Right.
But you contrast what's going on with these names versus traditional energy, XLE, Exxon, Chevron, all those old school names, and it is stark.
That's the story. The rest of the world is further ahead of us in terms of like adoption of clean energy, and they care more about it and they write it into their laws, and we're like dismantling those laws. But the other thing that's happening is, I think, ESG driven portfolios, and there are people that want to invest in energy but not oil, and they discover these stocks and they see that the attributes that you're talking about, like revenue growth, et cetera, and it gives them a place to put money and say that they're investing in energy and not have the stigma of, we're putting pension money into oil funds, oil companies. So I think that's definitely driving dollars. Forget whether or not you believe in ESG or you agree with it. Forget all that shit. This is like what people are doing with very, very large portfolios around the world. Institutional investors, they're really focused on this, and they actually, in many cases, have to answer to committees about where their allocations are going. So I think ESG is playing a role in driving attention toward energy stocks that are not carbon energy.
I think that's a good point. So these two ETFs are not even necessarily ESG ETFs. I mean, they're not. They're thematic ETFs.
Yeah.
But the iShares Clean Energy ETF and the Invesco Solar ETF both have $1.7 billion in assets. That ain't nothing.
No.
They were $440 million at the beginning of the year. So a lot of that is just growth, but a lot of it has to be money coming in. Same thing with First Trust as a global wind energy that went from very little to $215 million. So maybe flows is part of the story as well.
Yeah. And then, the utilities are playing a big role here. And Berkshire Hathaway, Mid-American Energy, I guess maybe they're calling it Berkshire Energy now, but it's basically a collection of utilities that Warren Buffett has spent the last 20 years acquiring. And a lot of the new construction that Berkshire is pursuing is solar and wind. But I was looking at this before. So they have a new project that they announced at the beginning of this year in their NV Energy subsidiary, where they're going to build a 690 megawatt solar energy plant on federal land in Nevada. Well, the current record for a solar plant is 579 megawatts. So it's going to be the biggest in the world or in the country by a large margin. And it's not their first. Berkshire has been doing solar and wind projects for a long time. At a certain point, the prices have come down for solar panels and solar infrastructure to make them more and more competitive with building anything coal-fired or oil, gas, natural gas. So that's what's happening, and it's real. It's not a dream. There are millions of homes that are powered by some version of clean energy, and it's going to keep going. So I think that's kind of cool to see. And to your point, most people probably aren't really aware of it that don't follow the space closely. I don't think it's a big story, but it is absolutely transformative right now. Let's get into this thing from Verdad Capital, our friends at Verdad. They do such amazing research, and they're a value shop, and they did a piece on FanMag, which is, Facebook, Apple, Netflix, whatever. So they were talking about FanMag Envy, and they looked at like the next tier of growth stocks and the insanely high multiples. They're specifically looking at sales to enterprise value, because now everyone's valuing cloud computing stocks on price to sales ratios. So they're looking at this tier of companies, and a lot of the names. These are like the cloud computing superstar stocks. And one chart in particular that they show, they break all the stocks into deciles, and they're looking for the most expensive enterprise value to sales. And they find that actually these companies have delivered. They say, before we get too critical, we must acknowledge these multiples reflect performance. Enterprise value to sales multiples have historically been good predictors of realized sales growth. So that, yes, these companies are expensive, but they're also crushing it, and they're actually creating value for shareholders. Why isn't that more intuitive to value investors, where they look at a high multiple stock and just say, it's not for me?
No. I think everybody knows that. I just think what happens is that these stocks often don't fail to deliver. So I don't think.
But he's showing that they do. That they do in fact deliver.
No, they have delivered. This chart does not always look like this. In theory, the most expensive names have the best growth, but they don't. It doesn't persist. And so the price just gets too far ahead of expectations, and any hiccup in growth, even if expectations are for 30% growth and they deliver 28, they could still get crushed. So I think value investors understand that very well. What they're saying is, no. We prefer to have a margin of safety and not pay up for growth that might not materialize. It's just a different mindset.
Okay, so Apple 2 years ago, right? The AirPods become a runaway bestseller hit. The App Store revenues all of a sudden go to like 20 or 25% of the overall sales picture. So getting further away from gadgets and closer to a true subscription services model. And it's selling 20 times earnings, and it's growing 15, 20%, give or take. And it's paying a dividend, and it's buying back stock. And then you look at that, and then you say, yeah, that looks cool at 20 times earnings. But you know what? I got this real piece of shit company, and they're making raccoon traps, and it sells at 0.7 times sales, and it's dirt cheap relative to its last 100-year history. It's what kind of mindset is it that you want to buy the worst piece of shit you can find because it's selling at a low multiple to sales, versus buying Apple that's doing absolutely everything right? I really don't understand it.
But that's one style of deep value investing. I don't think most value investors are trying to buy the shittiest company possible. So I don't think that's fair.
So what are they actually trying to do right now? Because
hold on, we're getting away from the point. The point is that the most expensive stocks have actually delivered. That's it. That's the story. Yeah. Is that a lot of time growth gets overpriced, and in fact, it's been underpriced. These companies continue to exceed expectations. That's the story. And I was actually shocked by this. Jack Vogel did a similar post recently where he broke down stocks from 1990 to 2019, stocks that were trading below 10 times sales and stocks that were trading above 10 times sales. That's it. That was the line in the sand.
10 times sales is actually pretty chaste these days. It's actually pretty conservative.
So over the last 10 years, it's been an incredible 10 years for all stocks.
Yeah.
Over the last 10 years, stocks that have a price to sales ratio over 10 times have annualized at 19%.
Right.
Versus stocks below at 15.7, which is still very high. It's been an incredible decade for stocks. Over the last 3 years, this is the widest gap. Over the last 3 years, they've annualized at 21% for the expensive stocks versus 13% for the less expensive stocks.
I know this is naive, and I know the quants work on this night and day, and there aren't any easy answers. But why not just say the best time to buy a value stock is when it figures out how to start growing again? Like, I look at all the people, all the money trapped in the large cap banks. We'll forget energy or any of that. Let's focus on financials, right? You have financials that are doing really well. They're just not
Hold on. Don't you think they've thought of this?
Well, let me make my point.
Like what you're saying is not so profound. They have thought of this. It's not that easy.
I agree it's not easy, but like, wouldn't that be a better thing to focus on rather than just pure value metrics? Why not just say,
I don't think you're giving them enough credit to think that they're not absolutely data mining the shit out of these fields to try and find what you're suggesting.
all right, perhaps they are. In the end, there is a ton of money trapped in Wells Fargo, Bank of America, Citibank, JP Morgan. These stocks, these companies do not grow. They're 1 times book value or below, and they have been for almost a decade now. There's absolutely no sign that they're going to find a new way to grow. I'm sure they're trying. But
they don't necessarily need to grow to deliver decent returns to shareholders.
Well, they do. They do because they are not allowed by the government to buy back stocks.
Opinions can change. Stocks can get re-rated. They don't necessarily need to grow.
Well, they have caps on how much capital they could return to shareholders. So if they're not allowed to juice their earnings with buybacks to the same extent that stocks and other sectors can, then I think they really need to figure out new avenues for growth if they want any kind of multiple expansion.
I don't disagree with you. Everybody knows this. Everybody knows this. Nobody's bullish on banks.
Right.
So it doesn't change much. And again, you could have said this 3 years ago. So it's tough. I get where you're coming from.
One thing that I would have expected to have changed the sentiment around banks is the boom in mortgages. Unfortunately, it's not. And a lot of mortgages are now being originated on the internet.
Yeah, but so that's a good point to think about how low mortgage rates are. The spread is like just not there. Correct.
But there's still money to be made. The problem is it's being made by Rocket Mortgage, not by Wells Fargo. I mean, these are just facts. And so maybe they might have just been literally disrupted out of any potential growth there is. I said something on TV the other day that got a big reaction, that one of the biggest fuck-ups in indexing in the last 10 years or so was designating PayPal and MasterCard and Visa as technology companies. If these were in the financial sector, then that sector wouldn't look as shitty as it looks now. It would have mega cap stocks that are going up and to the right. But those companies are like classified as technology or software. And I think it's a huge mistake. Those should have been considered financial, but they're not. So financial is dominated by growth impaired, quasi-utility large cap banks. And it's kind of a wreck. All right, let's not do any more on that. What do you got next?
I want to talk about this chart from JP Morgan. We've spoken about this a bazillion times, that the stock market is not the economy. So this is a really neat chart. I've seen it in various ways. I've never seen it like this. So they break it down, different sectors of the economy. They break it down by GDP. How much are they responsible for GDP? By employment, and by the S&P 500.
Okay.
And to me, I mean, this is obvious. The biggest story here by far is technology.
Yeah.
Technology is responsible for 6% of nominal GDP, just 2% of employment,
and 40%
right?
of the stock market.
Obviously they're incredibly efficient with what they're able to do.
Yeah.
And 40% of the stock market. And you know what's remarkable? Technology, just XLK, the ETF, Apple and Microsoft are 43% of that.
Right. So this is just a function of what investor preferences are. Like, in other words, the reason we have multi-trillion-dollar technology companies is because investors are prioritizing investing in the future and in growth.
By the way, to your point, financial services, 23% of GDP and just 12% of the market.
And shrinking. And some of that is classification error, because it's not like financial services activity is declining. It's exploding. The problem is Venmo, which is where people move money around, is not in the right index, right? It's owned by PayPal and Square, and then Stripe is going to come public. I don't know where they're going to put that. It would be like Airbnb coming public, and instead of being considered lodging, just calling it a tech stock because they have a great website. Like, I think a lot of these classifications have led to disparities in sector performance, where you look at this chart.
I don't really agree with that.
You look at this chart that you're showing me, it makes no sense. It's not reality.
I don't really agree, because You're right. You're right that Visa, PayPal, Square, I think might be technology as well. But they're not, I mean, they're big companies. They wouldn't necessarily make XLF look a ton
Yes,
better.
they would. PayPal is a $200 billion stock. What are you talking about? Yes, they would.
But no, they wouldn't.
Come on. If you put MasterCard, Visa, PayPal, and Square into the XLF, it would be substantially more balanced in favor of growth versus the way it is right now. Look, there are growth companies in the XLF, but they're tiny. It's like MSCI is a hot stock in the XLF. It's an index provider. It's a tiny company. But like if you had more fast-growing mid and large cap stocks that are in the S&P 500 and actually doing financial services classified correctly, the XLF would have had much better performance, and this would be less skewed toward the technology sector. Be a little bit better balanced.
I'll take a look at this.
Okay. You should do a post on that. I'd love to see if I'm right.
I will. And I mean, yes, the performance will be better. There's no doubt. I don't know if it necessarily would have saved it. So for example, XLF is up 47% over the last 5 years.
Right. That's a little more That's a little more respectable.
Okay. No. Let's do this. 3 years. It's flat over 3 years.
Right.
So if we put PayPal, Visa, MasterCard into XLF, what do we think the return's going to go from flat to what? Up 3 or 4%? Or you think up like,
if you weight them based on market cap?
Yeah, you think it's going to go up to like 10, 15%? I don't think so.
Well, you have to pull market cap away from so many underperforming large cap stocks.
I will.
So it will make a big difference.
We'll see.
You know how to do that?
Yep, I can pull that right from my charts.
All right, so run the numbers. I'd love to see it. Maybe we'll talk about that next time. I want to get into this thing from Reuters. Wall Street strategists had a really tough year in 2020. They have a tough year every year. No offense.
It's not their fault. It's ridiculous.
It's a ridiculous thing to have to, in January, handicap the S&P 500's earnings, like the full index's worth of earnings, and then B, come up with a price target, which is really just guessing at sentiment. Like the only way you could put a target on an earnings number is to guess what multiple on average we're going to be paying for the market. So
you can nail the fundamentals, and who the hell knows what the multiples are going to be.
Well, they didn't do either because something happened in late February that completely changed the world, which was, of course, unforeseeable by anyone. And the story was basically that they started slashing estimates the whole way down after the market was already falling. And, this guy, Mike Wilson, who's pretty smart at Morgan Stanley, he basically cut his target on the S&P the day the market bottomed on March 23rd or March 24th. And then on the way back up, most of them were underestimating the recovery for stocks and chasing the earnings revisions higher, which they still are. And so their targets went from being too high to then way too low. And then now they're all chasing the market back up. So it's almost like, what's the point? And I understand the point. I don't think they're telling people I'm going to nail my target. I think it's fodder for conversation with institutional investors. And it's a framework.
It's more than that because we're only seeing their price targets, but they're actually doing a ton of research that goes out to their clients, and all the headlines do is pull out the price targets. I
agree. But my guy Tony Dwyer gets the last word in the story. So Tony Dwyer is at Canaccord Genuity. He's a friend of mine, and he suspended his forecast in March, which I think is probably the most responsible thing he could have done. And then he reinstated it over the summer. And then on August 31st, he pulled it back because the S&P started to rise above his target. And he basically says to the reporter, it's a wild guess. And then Dwyer added he believed the overall investment thesis he provides clients is more important than, quote, a made-up target. I totally agree. Having the ability to talk with Mike Wilson or David Costin or Tony Dwyer and just get their sense of what's going on is so much more valuable than 3,600 is my target. The number is stupid, but I understand they have to play the entirety of the game.
I want to give the last word to Ben Graham because we always say, why even bother? Why do they do this? He said, nearly everyone interested in common stocks wants to be told by someone else what he thinks the market is going to do. The demand being there, it must be supplied.
Yeah, I think that's right. People might say, all right, I know it's hard to guess, but what would you guess? Which is fine. I get it.
All right, let's do this quick because we don't have much time. Last topic, Miles Udland did a really good post. Public is a new private. For years now, we were saying private is a new public, private markets that is, and now it's reversed. It's a boom. Companies are coming public left and right. You talked about this on your podcast last week about the renaissance in the IPO market. What are your thoughts on this?
Well, I think seeing a lot of companies that were privately held now have this really, really fast on-ramp into the public market is exciting, because I do think that when private companies go public, they get this currency that they can then use. They can incentivize their employees. They can hire more people. They can spend more on research and development, more capital spending, hopefully. And hopefully most of it doesn't get wasted.
Chamath just announced a reverse merger. One of his SPACs is going to take over Clover Health in a $3.7 billion deal.
Yeah, so
it's like a legitimate company.
Totally. So I don't have a problem with it. I just think from an investment standpoint, most of these won't work. Now you could say, well, so what? Because I get my cash back if the deal doesn't get consummated, or if shareholders vote against the deal, I just get my cash back. What's the big deal? What's the risk? I think the risk is people are paying premiums for SPACs, thinking that when a deal is going to get announced, they're going to get an aftermarket. They're going to get an after the news pop. Those pops are increasingly failing to materialize because there just aren't that many exciting companies that you can put into your SPAC. A really great example, there was a $16 billion deal last week from somebody who's a proven operator in the space. And they bought some kind of a boring business, like a record-keeping insurance business or something. And not only did the stock not pop, it fell. And so that's the risk. If you're paying a premium for a pile of cash and the market's not excited about the deal they announce, you're probably going to see this, a 10 or 15% fade. And if you're okay with that, then so what? Play on. It's not for me. I would rather wait till a deal is announced and it's a great deal. Even if I have to pay up, if I want to invest, at least tell me what I'm investing in. I'm not big on door number, what's behind door number 1, what's behind door number 2. That's not my style. All right, that's all I got for today. Let us know what your thoughts are on the topics that we've discussed, and we're going to try something new. We have an email address that you guys can send us topics that you would like to see on the show next week. That email address is askthecompoundshow@gmail.com. So go ahead and send us an email. Tell us what we should discuss on the show next Tuesday, and we will make that our 7th and final topic. We'd love to hear from you guys, and we will definitely start incorporating more of your feedback into the show, because I think that's a lot of fun and a great way to get some of your most interesting ideas involved. So go ahead and send us that email, and we will be back next Tuesday Eve.